Just a tangential question, but if I'm calling US the main mother economy because it's still the largest economy, and what the Fed does, others take notice. I'm just trying to understand, just tangential to the conversation that I'm having, I'll come back to that. But if the US is in a late cycle, if the Fed were to embark upon a series of rate cuts, etc., what kind of an impact does it have on other economies, let's say for India, which may not necessarily be in the late cycle, but is in the mid-cycle? How does India therefore follow suit or otherwise? What can the central bank do something different than what the US central bank is doing, because we are in a different stage of the cycle than what the US might be in?
So because you call US mothership, the way to think of it is that it's every other economy, maybe outside of China, is super levered on US. So the impact that you see in US instead of is significantly more that you see in India, Indonesia, or any other country. Okay, that's one basic framework. So if the US is going to slow, it will certainly hurt India or rest of the world. Even though every time you call it that we are now different, it never is, because in US is a marginal buyer of goods. So if your question is that if US is going to slow, would India too will slow? The answer is yes, it will. If Fed cut rates, would India cut rates? Answer again is yes, because that is the main thing that the RBI is looking for, not necessarily local growth inflation conditions, but enabling conditions should be in place for emerging market or India to cut rates. If Fed or ECB actually move along in cutting or dropping rates, it's likely that India would also find an opportunity to cut rates. So remember that India inflation is already at 3% core. So you already have a lot of space, and yet RBI is still relatively very hawkish. Only reason is not local economy is very strong. The only reason is that Fed hasn't yet sort of blessed us with a rate cutting environment.
Got it. So then the follow-up is, and I would love for you to distinguish for some of the people who might not do this very clearly, the difference between credit and bonds per se. But you mentioned that mid-cycle is credit, late cycle is bond. And late cycle is when the rate cuts start. Now, we may not be in the late cycle, but if the Fed cuts and if the RBI is forced to cut, let's say, then does it make bonds as an asset class more favorable versus credit, or that it's not a correlation like that? Also, just explain, how do people invest in credit versus bonds, because bond investing now has been made relatively easier by virtue of the platforms that exist as well.
So equity, you understand, it's mostly a bet on P&L, right, of a profit of a firm. So in some sense, it's a bet on the residual, as I call P&L. Credit is actually a bet on balance sheet of a firm. Now, balance sheet essentially means that whether the balance sheet has enough assets that can absorb shocks and has ability to repay, even if, let's say, overall revenues were to drop. And then bonds are actually bet on inflation. So inflation is certainly down, and therefore you can bet on inflation right now. Thereby you can actually bet on bonds. Bonds will drop. I am calling out that it's likely that the profits will not do well over next couple of years, 1 or 2 or 3 years, versus market expectation. But because Indian balance sheets are squeaky clean, for good 15 years, there has been sort of some form of deleveraging sort of playing out in India. Okay, so it is amazing. Even if it is late cycle, then also the markers of a late cycle in balance sheet, or let's say rating downgrade standpoint, has not yet kicked in. The leverage ratios in Indian corporate that we track, the leverage is debt equity, is at one of the lowest level in last 40 years. The margins are at 15-year high. The coverage, which is how much interest is there for you to repay the debt payment, or DSCR, are at very, very high level. So basically the balance sheets are super strong, and their ability to absorb what you call shock is very high. So kind of think of it like this, that if a AAA company, okay, you were to face a recession, it would still very likely remain AAA because its leverage was very low. What has happened in India is that today a A-rated company is the financial specs or the balance sheet of it is actually closer to what it was for a AA company 5 years ago. So A is mimicking the performance of AA. So in some sense, the entire landscape of what you call balance sheets in India, mid or large balance sheets, has been lifted quite dramatically. And which is why I say that it's a safe call to take, even if we are in late cycle, though I think we are a little bit of a mid to late, to actually bet on balance sheets from a credit standpoint.